Oh, thank you for watching this video. In this video, I'm going to talk about how to calculate debt to ratio. And for the example, I will use the QuickBooks Online. Okay, so what is debt to equity, or it's also known as DE ratio in financial world. So debt to equity ratio compares your total debt. Total debt could be your long-term debt you borrowed for buying some equipment or buying a car, and short-term loan could be like your credit cards and some other money you owe to the vendors. And then the equity is your value, like how much money you put in for your business. It could be from your shareholders or your partners or your own or your could be any number of owners. So that's the equity. So this represents the proportion of financing from credits that your debt versus your owner's equity. So the debt is, as I said, the components, uh, any short-term borrowings, long-term borrowings, and whatever it's on any debt you have on your company's balance sheet. And the owner's equity is the component that includes your contributed by owners, shareholders, partners, and whatever is on your retained earnings, and it could also include the current year income as part of the equity. So that's your equity side. So in general, there's no hard and fast rule on this one. So in general, if your DE is too high, that signals that the company is at risk of being unable to meet your required debt obligations. Obvious. If you have too much debt, uh, more than your equity, then you have a high risk of not meeting the debt obligations. Uh, but on the other hand, if it's the debt low, is low is if it's a low, it's not necessarily a positive sign, as the company could be relying too much on equity financing, which is costlier than debt. What does that mean? You know, okay, the bank is not giving you a loan, and or you don't want to get a loan from the bank, and you just borrow from your uncle, and now the uncle is part of your owner, or you have partners, you just sign up partners with someone. The partner wants your company now. So whenever you make a huge profit, then you have to distribute that profit to your partners or your owners. So that could be costlier than just borrowing from the bank, at certain interest rate, like let's say 6%, 4%, whatever it is. So there's a balance to make, which one is better for your business. Okay, so in this example, I have the balance in on the right side here. The DE ratio is 0.49 times. So it's basically, I'll go to the QuickBooks Online, and you'll see uh, in the balance sheet. But in this example, you have the liabilities is 512, and equity is 1051. That's all thousands. So the ratio is at 0.49 times. Uh, and so that's what it is. In this case, it's less than one, and it's you know pretty good. So you have 0.49 times. Okay. So and if you have leave a comment if you have any question, or be sure to subscribe to our YouTube channel. And now I'm going to go to QuickBooks Online and go over this a little more. Okay, so I'm on QuickBooks Online. Let's just go to the balance sheet. So I'm just going to run the summary balance sheet summary, and go over this. Okay, so in here you'll see The liability side is your total liability. That includes your accounts payable, credit cards, other current liabilities, and then you have a long-term liabilities. You may have a very totally different current liabilities and long-term liabilities, but so that's what the total liability. Whatever you see in the total liabilities, so that's the one you want to use. And on equity side, it could be the total equity, and it's basically, 512 and divided by 1051, you get that ratio, you know. And if you want to see what's included in the equity, then in this case you have to go to the not the summary, only you have to use a different report. Okay. Here's the balance sheet one. That's not the summary one. So if you go down all the way down, you will see. In this case, this my uh, demo balance sheet. So these are all kinds of equity stuff. So in your case, the equity could be owner's equity, like here, or the partner's equity. And in some cases, if you're a publicly traded company, you'll have shareholders and bunch of other par value and all other stuff. So basically that's what it is, and then you retain earnings. So in this case, it's never distributed, so that's why this is used. And then you have a net income from current year's P&L. So that's your total equity. That's how you get it. All right, so that's what it is. I hope this video is helpful to you. Be sure to subscribe and leave a comment if you have any. Thank you. Bye.